All right, guys. So this one, how to trade economic numbers and events. You gotta, I gotta repeat what I just said because I wasn't recording. You gotta really understand trading. There's a reactionary sense of how to understand events and data. You can't, like an economist, you can't worry about overanalyzing numbers. You have to know what numbers are important to ignore the ones that are not. Um, I could give you a definition of every number I'm going to go over in my head. And it's only because of my experience of knowing the importance of these numbers from early on. And I didn't have to take a course on it. I just, as you know, we had this thing called a morning wire, which I'd like to reintroduce as we get rolling through the spring and summer, of a briefing on what was going on overnight, fundamentally, what was going on in the overnight session, but also anything fundamentally with, like today would be, some of the Greek news and the Iran nuke deal, some things like that, right, that are kind of ongoing. So we would read summaries on what this analyst that we had that would put together, and he'd pull extracts from, like, Goldman Sachs would have a research on this and that. He pulled it together and create the morning wire. And in the bottom left-hand corner of the first page was the economic calendar, the data. Well, he'd only put the data that was important for market moving numbers, right? So we kind of knew what was important, what wasn't, and he'd have an asterisk next to it. So it was like, you just know then, and what you guys are going to know coming out of this webinar, what's important, what isn't, and where to find quick definitions and why traders care about it. Then how to understand it as a trader, not like an economist, right? So this morning wire wasn't read back to front, and I've been able to replace it with a resource like Trade the News and some data or information Bloomberg.com gives you on their economic calendar, and I'll share with you guys those resources at the end of this webinar, and I'll do it on the screen share so you can see how to go through it to kind of prepare for the session and really hone in on understanding this as a trader. Because if you don't, man, you're missing out on some good opportunities, but you're also going to subject yourself to getting stuck in asking the worst question of all, and that is, why did that just happen? If you ask yourself that question a lot, or you're saying that out loud or to yourself, then you're not privy to what you should be privy to. You're not a pro. If you're not watching, or if you're not able to attach a reason for a big move in a very timely fashion, you're not a pro yet. You're missing something. You got to fill that void. So kind of an agenda, what to expect. This won't be terribly long, and I'll have questions. Obviously, we'll go through questions as we do it. But big numbers, big misses, what do they mean? Resources, the when and where to find this stuff. Other events, meaning other events that are affecting the markets, not just economic data. And then a recap, questions to ask yourself. And then the sketch pad I'll put at the end on the last slide to kind of illustrate this March unemployment report, the last one we had a few weeks ago. So let's start here. Big numbers, big misses. Here are the sectors I put in and what the numbers are. Manufacturing, housing, jobs, consumer confidence numbers, energy supply numbers, inflationary numbers, central bank stuff, just straight economic numbers, treasury auctions, right? Don't get too confused and don't write all this stuff down, because you'll be able to watch the recording and you're going to be able to look at a calendar that further separates this stuff. Manufacturing numbers are like the ISM number, comes out first business day of the month. And by the way, it's March 31st, if you guys are watching this on recording, 2015. So tomorrow's April 1st. First business day of the month, this ISM number comes out. Big manufacturing number. Chicago Purchasing Managers just came out today, March 31st. Philly Fed's a decent sized one, New York Empire. All manufacturing numbers. Housing data, new home sales, existing home sales, and housing starts are the three biggest housing data points in the sector, especially when the market's worried about how housing is doing. If you're trading stocks, these numbers affect the builders. Pending home sales is another one that's pretty decent, but not as big as the other three, and then the housing market index. Finally, jobs. This is not finally, but jobs is the biggest number of the month. Always has been since I've been in this business, and probably always will be. The payroll number comes out typically the first Friday of every month. ADP, which comes out the Wednesday before the first Friday, which started about 7-8 years ago, being a precursor, maybe a tell as to what to expect the payroll number to be. The payroll number, and I'm going to get into how to slice and dice the consensus and range of expectations in a moment, but that's a number to watch, 7:15 Central. I could tell you the release time of all these numbers, and that's where you got to be. Like ISM is always 9 Central. This is 8:40. This is a 9 o'clock number, used to be 11. This is a 7:30 number. Existing and new home sales are 9 o'clock numbers. A 7:30 number, 9 o'clock, 7:30 Central, 7:15, right? Jobless claims, I put an asterisk next to it because it's a weekly number. Sometimes it's blown off. A lot of times it is. But if it misses big, it can have an effect. It's a 7:30 Thursday weekly number. Confidence number, consumer confidence. Because 70% of the economy is based on consumer spending and everything else. The biggest engine of any economy is consumers. Their confidence and how they feel are important. The last couple days of the month, that number comes out. University of Michigan puts out 2 surveys, one in the mid-month, one at the end of the month. The mid-month one is a little bit more important. It's a preliminary look, and it tends to miss more than expectations. Remember, these are just the bigger numbers of the month. If you're an energy trader, nat gas or crude oil trader, API releases a Tuesday late afternoon number on inventories, followed up by the EIA on Wednesdays at 9:30. 2 big numbers, and their weekly releases. Nat gas has their storage number on Thursdays at 9:30. Inflationary numbers, PPI and CPI, stands for Producer Price Index and Consumer Price Index. They haven't been watched over the last 6 or 7 years because inflation hasn't been anywhere near on the radar for traders and economists because of all the crippling that this economy has done because of the housing market, the financial crisis of 07 and 08. And it might come on the radar, and when it does, those 2 numbers will be watched and be more important. They're inflationary. Central banks. This is more on an event type under the event umbrella. All right, Drew's back. So we got 3 guys to make fun of now. Bob, Drew, and Carl. All right, let me get back to this. I knew, it's either Bob, Drew, or Carl that interrupts me and distracts me. My whole life. All right, so central bank stuff, FOMC statements. The reason why I put them here as a number is because they're generally scheduled. Every 6 weeks, the FOMC meets. It's always a 2-day meeting. It's always Tuesday and Wednesday, and now it's always 1 o'clock Central. They release their statement. You got to know how to preview that and review that. You got to know when it's coming out, why it's important. Also, the FOMC minutes, which is actually this week. Is it this week? I thought it was this week. It's coming up. FOMC minutes, a little bit more detail of what went on at the last FOMC meeting, and they're only 3 weeks old. The FOMC minutes used to be 6 weeks old. They were less relevant. About 6 or 7 years ago, they upticked it to 3 weeks, and so, or even longer than that. So these minutes are an important event to watch. Any speeches given by Fed officials or ECB officials, which is the European Central Bank, the cousin of the Federal Reserve here in the U.S. So they're talking, they're scheduled to talk. Shouldn't be a huge surprise when they say something that can move the market. Does the market move every time a Fed official talks? Of course not. Testimonies in front of Congress, 2 of them given by Janet Yellen every year. Important to make sure you're aware of them. Press conferences. Every ECB meeting, which are on Thursdays, there's a press conference at 7:30 Central. Draghi, who is the counterpart to Janet Yellen, gives it, and that's important. It moves the markets around pretty substantially at times. Beige Book, it's a smaller look of what the Fed, of how the Fed is what they consider some economic activity. It's not a big release, but it's under the central bank umbrella. ECB, like I mentioned, is the second biggest central bank to watch. The Bank of England's a big one, the Bank of Japan, the Bank of Australia, Bank of China. These are all central banks for these different countries or continents that are important to know. It's not what they do, it's what they're supposed to do, is always what's important. We're going to get into that in a moment. Straight economic numbers, ISM, non-manufacturing numbers, pretty big. Retail sales can be big. Durable goods can be big. Industrial production, a smaller but okay size number. Hadn't been market moving lately. Then finally, for treasury traders, pretty much only, and I'll have Woj come on the next time and explain how to trade a treasury auction. But there's 2, 3, 5, 7, and 10-year note auctions every month and a 30-year bond auction. They get released at 12:01 Central. That pretty much covers it up. This is a pretty boring slide, but it's important. It's not boring to the point where this is what you should know. These are the big ones. If I didn't mention a number or release that you'll see on an economic calendar, it's probably not important. You'll hear Trade the News and you'll see other different economic calendars report it. If it's not on this slide, it's probably not relevant. So let's go to the when and the where. When do these numbers come out and where are they supposed to come out? It's all wrapped into a consensus. They literally take a survey of, I think, 40 some odd economists and come up with a consensus of where a number should come out, right? And then they take the high and the low and they have a range of consensus. I'm going to show you on the calendar I look at that you should have bookmarked after today, and it's a range of consensus. So it's important to know that the number is supposed to be 57. That's not special or like secret information. You should know that. You should know what the market consensus or what's baked in the market. Range is another layer that you could uptick in your trading expertise to have a bang for your buck, that I call it. Range of consensus is nobody thought it was going to miss that high or nobody thought it was going to miss that low. All right? So it's a bang for your buck. I'll cover that again in a moment. Resources. Where do you find this stuff? Bloomberg Economic Calendar, I think, is the absolute best free resource for not only this stuff, but then good definitions of these numbers. I was going to take time in putting up the definitions of these numbers when I could refer you to a free link and website, and you could, at your own time, they have a Why Investors Care section. I'm going to show it to you. Trade the News is another resource I use. The third resource I use, believe it or not, and I didn't put it on here, are other traders. I can't tell you how often I open the room and someone in the room tells me something that I didn't see on the resources I use. So other traders, when you're around people who know what to look for, know how to analyze these events, is another resource. Now, other events. Before I go to Bloomberg and Trade the News and show you these pages and what to look for when you guys, if you want to go deeper, and you should, there's other events that are outside scheduled events, okay? And that is central bank activity, we mentioned, is usually scheduled. However, geopolitical wars, unrest, terrorist attacks aren't scheduled. So it's important. These can and do move the market. You got to stay on top of when they're going to hit. if you plan on trading any more than a few months, this stuff's going to affect you. This is going to make or cost you money at some point in your career, period. Bailouts, for example, Greece was one a few years ago, permeating back and resurfacing through the markets again. A couple months ago when they extended, now they're back in the market. It has effect. It has opportunity to get long and get short or get the heck out based on market reaction. Again, able to answer the question, why did the market do that? Now you know why. You could tell someone else why it's going to do this. So bailouts are important when they come out. Greece is one, and of course we had a huge bailout stories back in 2007 and 8 and moments again and again throughout those years. Political turmoil, whether it was the debt ceiling a few years ago, that fiscal cliff a couple of years ago, government shutdowns, like those things came and went. They'll come back in another name. Might not be called a fiscal cliff. Be something that's important to the market, that the rumors, let me add that. Let me just cover earnings. That should be pretty simple, right? Earnings, but of bigger companies that affect the indexes. So as index traders, which most of you guys are, and I am, the earnings that we pay attention to, and we'll get better at this, are the ones of the bigger companies that weight the index more. So then the next day, if their earnings miss and the stock is moving around a lot, that could lead the index that day, or certainly have an effect on it. Rumors, and I get back to rumors. It's not just the rumor, but then the denial. You got to know what the rumor is in a timely fashion, and if not, the opportunity is the denial of a rumor. And the rumors, again, unless you're planning on only trading the next 2 or 3 months, this will affect you. There'll be a rumor that moves the market lower. We might not know it. It's a rumor. All right, fine. The next thing is the denial of the rumor. Someone comes out and say, no, that's not true. And that just happens all the time. Whatever the rumor is always gets dispelled. There's opportunity on the reverse trade. It's going to come out. So you got to be ready for that. During political issues like the debt ceiling and you'd have one political leader say something and it was going to have effect, then it came out of nowhere. It wasn't scheduled. So-and-so said this and we went up or we went down. And it was like opportunity after opportunity, or keep yourself out of harm's way and at least know that this can and is affecting your market right now. So the market profile, moving average cross, stochastics above 75, that's all lining up in a perfect storm, is thrown out the window because it don't matter. Nothing matters when something that's driving the market is just hit the headlines. We used to call them tape bombs. They'd hit the tape and they'd explode all kinds of market reaction. After 9/11, the next few months, as bad as it was to make money off of those events, there was opportunity for, what was that white powder called? Anthrax. An anthrax scare, or there was white powder found on a congressman's letter. Markets would just tumble. And there's just all kinds of stories because the market and the global stage was on edge for a few months after 9/11. After one of the bigger events I remember trading from a global story was the Bush-Gore election, when they didn't know who the hell won in 2000, in November of 2000. And if it was going to come out that Bush was going to win, the markets liked it. It's the whole Republicans better for stocks. And if Gore was going to win, we go down. And so as that kind of played out, it was important to know how it was going to affect the market. So keep it simple. That's the underlying overall theme of the edge. Simple. Simple, simple. How is it going to affect the market? And then how the hell does the market react? So let's go to some recap questions. And these are important to write down, not now, but later, in understanding market reaction as you guys kind of go over and make this a separate kind of study that you do, where this week you're just going to go over these questions and how the numbers affected the market and what kind of read it could have created for you. So these questions are important to ask yourself. How big of a number is it? Meaning, is it a payroll number like the unemployment report on Friday, or is it durable goods? They're both important, but one's way more important than the other. That's about your market awareness. How big of a miss? That's answered by knowing the range of expectations. Where was the market right before the print or event came across the wire? We always say that. You've heard me say that dozens of times if you've been with me a while. Know where the market is right before the event. This market got weak again. Next, was the reaction in line? So the number came out. It was a bullish miss. We rallied. Well, that's not good news. We're supposed to rally. If it wasn't in line, that's where the clue is. And then how far did it go? I'm going to show you that on a sketch pad. So it's supposed to rally. How far did it rally? What was the top of the move if it was a rally? And then how quick did it come back? I'm going to show you this first on the sketch pad. Then I'm going to show you the March on a chart, the March unemployment reaction. And then I'm going to show you Trade the News in Bloomberg. Maybe not in that order. So this is where I like the sketch pad because it keeps things simple. How quick? So if a market starts at this pink X right before the number, it's just going right here. A number comes out and it's a bullish print. Let's take the payroll number. All right. Payrolls are supposed to come out at plus 100,000. Means 100,000 new jobs were added to the economy in the previous month. The range of expectations, and this is how I even write it down, are 75 to 125. Okay? Or to 125. So this is a nice collection. When they survey these economists and when they pull the research from Goldman and Merrill Lynch and these big investment banks, the consensus comes to 100,000. But you know what? Some guys thought 125, and that was an outlier, and a couple guys thought 75, but that was an outlier. High-low. So this is the unemployment report. All of a sudden, the damn thing comes out 165,000. So not only does it miss the consensus number, but it misses to the upside and is outside the range of expectation. This should have the bulls chanting in the streets and the market starting right at that pink X and spiking up. Okay? Couple things. You got to know where it started because that's the ultimate line in the sand. Let me erase some of these drawings. You got to know where it started, and that's like right here, right before the print, and you see this big spike. The reason is because that's the ultimate line in the sand of if we get below that, then you really got to say, what in the hell's going on here? We just got the biggest number of the month with a huge miss, should be as completely bullish of a miss, the fact of how big it missed, the fact of how big the number is, and we go back through where we started. That's the biggest and best clue in analyzing a number like a trader at ground zero. If you could explain that back to someone, then you're starting to understand these numbers like traders. Now, there's a lot more to understand or be able to trade this kind of volatility, but that's a nice helicopter explanation. How quick did it come back? If it came back quick and then rallied, that's just the volatility in it. If it came back only a little, well, let me erase this again. If it came back, started here, this is ground zero, and it spiked up to here, and it only curls back a little bit and chops around, and it's only still, if you think about it, still above the halfway point. So this is where it started down here. This is the high of where it went, and now it's still only pulled back a little bit. Man, you've got some people short dying to cover this thing, and it won't come back for them. And that's when I'll find a good momentum upside to take, like right in here, to trade this thing for a continuation and filling out the bullishness to the upside. So if I miss the first move up and see a pullback only come down like 50% or a third, wow. If it starts to leak down to here, I start to say, huh. And I remember the owner of the company saying this to me. He said, if it was that strong, why does it come all the way back to where it started? You got to begin to start questioning the validity of the strength if it can't stay above where it started. And as it tests where it starts, that's when you begin to scratch your head. If it starts to move below where it starts is when you have to say, maybe I should be bearish in this example. All right, so that's the sketch pad part of this, where it's where it starts, it's where it first goes to, it's where retracement is, and then where the continuation should be. If you play this out, what is this? This is a trend. But you know why it went up. You know that it can't come back down to where it started. And you know that the continuation should be intact to have it fill out this leg of the rally. Now let's take it the other way. Let's say on March, I can't remember the date, but it was the March unemployment report almost exactly a month ago. Bob, I don't care that someone you know made a small fortune in airlines. I'm just joking, Bob. I flashed over and seen his comment. All right. So the market starts here and it rallies up in March, and we're going to see it. I remember the price. I think it was 0350 was the high of the spike. I'm going to show you this on a chart. Market came back and went through where we started. That's when where we started is probably resistance. But at least the call of being a bear is really confident and high probability. So then you start using the setups that we have in the edge, or the ability to pick good short locations. You know, if you get you're trading well and I'm trading well when you're really confident on direction, now you just got to pick location. And the edge gives you the skill to pick better locations, and then works backwards at trying to create the skill at picking a high probable direction. But you're feeling good and you're trading good when you're confident it's going to go up or down. Now it's just about when. If you get this set up in an economic number and your confidence going down, you're probably going to trade well as long as your execution is decent. Let me answer this question because it's a good one by Bob. Would it be worth knowing which ones are doves and hawks? And yeah, Trade the News says that. It would be like Bullard's a hawk and he's got some dovish comments. So that is important. And I'll briefly go over it now, but a hawk is a central banker who's in support of higher interest rates. A dove is a central banker who's supporting the same or lower interest rates. Hawkishness is to tighten monetary policy. Dovishness is to loosen it. When you tighten monetary policy, you raise rates. When you raise rates, there's less people borrowing. Less people borrowing means less money out there. When there's less money out there, it helps fight inflation if inflation is a problem. And that's why the number one mandate of the Fed is to fight inflation, not to spur economic growth. That's a kind of a mandate, but not the number one mandate. to help stimulate economic growth, you do what? You lower interest rates to incentivize borrowing, and there's cheaper money, there's more jobs, and everyone's happy until there's too much money chasing too few goods and services, and that's the easiest definition of inflation. Prices go up uncontrollably because there's too much demand for them. So the Fed's got to pull that back. And if they chase that, they're in trouble. That's what people are worried about now. They wait too long to raise rates, they're going to end up chasing inflation. So, because it takes a while for the interest rate moves to permeate through an economy. Also know that the equity markets love typically low interest rates because money's cheaper. Borrowing costs are lower. Stimulates economic growth. Better for the economy, better for stocks, better for stock indexes. Higher interest rates they don't like. Doesn't mean they're going to go down all the time in a interest rate environment that goes up. It's all about what they're expecting. Remember, expectations should be built in, so you could pull clues out when something happens that shouldn't have happened. All right, let me go over the economic calendar on Bloomberg. Did you pull them? George pulled his 68 quarters. All right, let's go and let me show you a couple things. Hold on a second. All right, this is Bloomberg.com/market/economic calendar. All right, and I'm not going to spend a lot of time on it, but you guys should if you want to know more about these numbers and just the ones I listed on my slides. All right, so you're looking at this personal income and outlays. Don't worry about it. I didn't have it on my sheet. Pending home sales, it's on there. So what's cool is they got yellow stars, but don't go by each yellow star. The red ones, like this international trade number, is not a big deal for indexes. Claims isn't as important as the unemployment situation. All right, let's go over tomorrow's number. So you click on this if you're on this website, all right? You click on this icon. It tells you when it's coming out, and then you look in here, and it says last month came out 52.9. Okay. Consensus, 52.5. Range is what I'm talking about. For ISM, it's usually a pretty tight range of plus or minus 2. So 50.9 to 54.1 is the range of expectations. Recent history, this gives you a nice summary of what this number has done over the last few months. Definition, why investors care. So this is nice to kind of understand what the heck this number is. You don't read this. I don't read this. I don't read either one of these paragraphs. I just look at this and then click back. But if you don't know anything about it, read it. It's a good summary and it's a great resource. So now I back out of it and I go, let's go to the unemployment report on Friday. So Trade the News puts out some previews on numbers and stuff that I'll read, especially the bigger ones. I'll read this paragraph sometimes that Bloomberg puts out for unemployment. Plus Trade the News puts out a preview for this number as well. I'll read that. But look at this. And you look at this, you're like, oh man, there's a lot of numbers. Where do I start? First of all, average hourly earnings is more of a inflationary number within this release. So it's ignored. Work week, ignore it. Private payrolls, semi-ignore it. These are the two big ones, non-farm payrolls and the unemployment rate. Tells you where they came out last, tells you the consensus for Friday. This could change after tomorrow's ADP. So you look at this as close to the release as you can. 247 is where everybody is thinking it should come out at. 200 to 271 is the range. The rate's 5.5, same as last month. 5.4 to 5.6 the range. Why is this important that there's two numbers inside the report that are important? Because one could miss bullish and the other could miss bearish and get a nice whipsaw opportunity. So let's say non-farm payrolls misses 300,000. Well, that's bullish. Let's go up. But the rate goes to 5.5 to 5.8. It probably won't happen, but that's bearish. Unemployment rate goes up. It's, more people are to work. If both of them are in line and are bullish, you should get a good reaction to the upside. So last month, the consensus was around 240, I believe. Well, it came out 295 right here, right? And the rate was supposed to be 5.6. It came out 5.5. So the rate was good. Less people were unemployed. And there were more payrolls added to the rolls in February than expected, and outside the range, 295,000. Bullish miss, right? Not just in the payroll number, but in the unemployment rate component. So we should go up, and away, and probably maintain an uptrend, at least temporarily. But we didn't. And we're going to look at a chart of the March report in a second. Let me answer some questions. Any events are released before they are released. The Chicago number has a private subscription release that comes out at 8:40 Central and 8:45 the public gets it. We kind of went over that in the room today and how that happens. University of Michigan used to have a private subscription base. They don't anymore. There are leaks to earnings. There are sometimes leaks to some of these numbers. There are high-frequency computers tied in. This is how crazy things get and got. And this happened about 10, 11 years ago. This started about 10, 11 years ago. Let's go back to the sketch pad. So you would have, and this is how simplicity plays into genius. You would have a building that would have the guys on an embargo. They'd be in this building, and they can't press send to all the wires, to all the rest of the world. They'd be in a building, and they can't press send till 7:30 Central with a big unemployment report, right? So the Department of Labor, remember the Department of Labor Statistics, the BLS, the Bureau of Labor Statistics, get this number, they compile it. They have this number on Wednesday night, Thursday morning. They give it to the president, and the two people have it, the chairman of the Fed and the president, a day early. So, but there's an embargo, and they're in this building, and they press send, it goes out on all the cables and all the wires to the rest of the world, right? Well, high-frequency machines, they tagged into this wire as close to the building as they could and be able to decipher the number and then execute on and in the book milliseconds before some trader physically seen it with his eyeball on the screen. Actual physical advantages. And then the high-frequency traders, the HFTs, took it a step further and started to find ways to front-run big orders. But I don't want to turn this into HFT webinar. It's just there's an advantage in knowing these numbers, but then also how the market reacts to them. So let me pause this for 1 second. Stop the recording just for a sec. All right, George. So you're right before the release? No.
No.
Where are you at? Oh, it's back here. Where is the release? Ah, there it is. I thought it was 03, the price.
What are we looking for? The Fed release?
No, the unemployment.
Oh,
March 6th.
March 6th.
You know what it was? And that's fine. The prices are different, guy, per the contract. So 8:30 March 6th, your time, 8:30.
8:30 March 6th, my time.
Yeah.
I got the 5th, 4th, 5th, and then it jumps to the 8th. I don't know. I don't know where the 6th would be.
Isn't that when the unemployment was? March 6th? That's on a, seems like they've got that as a weekend. All right. I want to see, open it up, fatten it up a little bit. Oh, that looks good. Yeah. Back over. Left. There you go. All right. Perfect. So this is the June contract, and we probably trading the March contract at the time. That's why it went up to 03. This one spikes up to like 95 and a half. Right after the release, circle 95 and a half, George.
All right.
Or, you know, that spike. Circle the spike after the 8:30. Now it's 8:30 East Coast time. It gets released. Perfect. So both the non-farm payroll number missed to the bullish side. This guy. Gotta mute that guy. He scared the hell out of me again. So where George circled it, the non-farm payroll number on March 6th came out bullish. It missed 295,000, well outside not only the consensus but the range. You know how we have a bullish gap open higher day? You know how we open not only above yesterday's close but above yesterday's high, and that's bullish? Well, that gives you kind of more bang for your buck as to the strength. Well, it's the same with a consensus range. It not only missed above the consensus, it missed above the consensus high. Nobody thought it was going to hit 295, and it did. Wow, that's bullish. More people were hired and jobs created in the month than anybody ever thought. Wow, that's perfect. Then you add the unemployment rate downticked. It was supposed to be 5.6, and it printed 5.5. Well, great. Less people are unemployed. That's good for an economy. More people working, more jobs created, up and away. You see the spike high, and then in that green bar, and then look at that red bar right where you're, well, that's my cursor. The big red bar after the 8:30 release, George. That one right there. Draw it down. So right there is that example that I drew on the sketch pad when I worked at the prop firm. They said, why in the hell would the market do that with a big number and a big miss, both bullish? If that doesn't get you to scratch your head as to the market giving you the best clue of all, it's not doing what it should do, and it's not doing what it should do in a very, very timely fashion. Like it comes back pretty quickly within the first, 10 minutes or so. The next rally was met, and then look at the downside. So erase those illustrations, George. And I can guarantee you this, and I haven't looked, and I vaguely remember, but I can't be for sure. You see that after that big down red bar, those three green bars that walk up a little bit? Yes. 1, 2, 3. Right. That has to be somewhere got to be sold to take advantage of this downside that's coming. And this doesn't look like a big break. This was a 30-point break by the time we reached the afternoon. 30-point S&P sell-off after the unemployment number, which, oh, by the way, was bullish. So if you just woke someone up at noon on March 6th and said the S&Ps are down 30 points, they would have said, wow, they must have, the non-farm payrolls must have came out low and the unemployment rate must have spiked to 5.8. No, you jerk. They both missed to the upside. 295 in payrolls, 5.5 in the rate. You see? It's not a clue where the number comes out. It's a clue as to a reaction that doesn't fit. The guy kind of smiling when he tells you that he didn't take your money. You know, it's the clue of a guy scratching his hat or scratching his head every time he's bluffing and you're playing cards with him. It's not reading Carl and Bob and Drew's questions, because I know they're not going to be good ones. It's the clues that we have to save us time and give us good information. Now, here's what I want to say. Erase those illustrations. I want to make a bet. In that big red down bar, George, see the big down red bar? Don't circle it, but yeah, that big down. If you open up these candles in the footprint, I bet we have a thin spot, red, 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 that top green bar went up to and stopped and used as good resistance. Now open up these bars and let's look inside that big down red bar. Oh, the data's not in there. Is that what the problem is?
Yeah, the data's not in there.
Didn't go back far enough.
Yeah.
You got to redo your settings to go back more than 30 days. Don't do that for now, because it might take a while because the session's still on. I want you guys to look on your charts. This big red down bar, circle that big red bar that you have. And where would you get short on these next three green bars? Where would be decent shorts? Before those green bars came up and then went down. Pull your chart to the right, and so the last bar is the big down red bar. So it's as if like in real time. Right there. No, one more. There's the report comes out. Whoa, wait a second. We can't rally? Nope. Goes down. Right at this moment in time, this is real-time analysis, and we did this in the room, March 6th. This is where you lose your horns. And the market now has to start, or the trader has to start qualifying a short, a location to execute a short. And I'll click it over a couple bars. And it walks up. What is this, a 6P now? It walks up, and then the bottom falls out, and we never come up to these prices again. Hell, we haven't been up to these prices since then, have we?
No, we did.
Yeah, you're right.
But
You're right. Yes, you're right, after the Fed, and then it rolled over, and now it's trying to walk up. Now, Brad brings up an interesting point. I've covered this before, and it's always worth repeating. What's the reason why you can't rally even for 10 minutes after a bullish big number? In this particular moment, this was a week or so before the Fed. And what was in the market, and this is what's important about economic events and knowing it as a trader, it was the central bank reaction. You have to know that a Federal Reserve that would raise rates in the summertime is bearish for stocks. We don't want to see rates raised in the April meeting or the July meeting. We don't want to see rates go up in the spring or summer. It would be bearish for stocks. Well, with a strong unemployment report, at this particular moment in time, in the chart that you're looking at, gave traders and investors the thought this could be the excuse for the Fed to raise rates sooner rather than later. That's why we went down 30 points that day. The clue was right here in real time. But the reaction was, if you were, even if you weren't a great market timer, you still at the end of the trading day should have said we went down because the market started trading a sooner rather than later rate rise for the Fed because the unemployment report gave them an excuse to do so because it was so rosy. Make sense? So it's funny how you'll start trading bigger numbers, bigger misses, the opposite. Our job is to get the clue as soon as we can. Still got to pick good locations to execute, don't get me wrong, but at least the direction, have a little more confidence with direction, and the direction typically has a trend to it. Like that Friday, March 6th, had a nice downtrend look to it the entire session pretty much. Ken said the FTSE did exactly that today. Great figures, big drop. The FTSE is the stock index for England. What were the figures? German unemployment report? Anything else? And this is March 6th. I guess the year 2015 that we're looking. There'll be people that will watch this on a recording years from now. Because nothing will change. The one thing that people could get from it's not my methodology. It's not my proprietary methodology. But the one thing, if you watched a video I did from a few years ago, nothing changes. There's better ways to explain the same thing. When you're wrong, you're just wrong about timing and trades, but your fundamental principles are the same. Those that maybe just started this week on the edge, you got to go back and do the course and do these group coaching sessions from the beginning till now. And things will kind of settle in a lot better and easier for you. Let me go through some questions. So Brad also adds, could I discuss or when should that inverse relationship for numbers end? And I don't have an answer to that. It's almost when the Fed kind of gets locked into a routine of raising rates. Like that, remember a couple of years ago, Bernanke at one of his testimonies said he introduced the word tapering when they were going to start pulling back on the bond purchases of $85 billion a month, and it was a shocker, and the markets took a bath. It was May of 2012 testimony, and it was a pivotal moment where bonds just got absolutely blasted, and that was the beginning of a rate rise at some point in the future. But first they had to taper their bond purchases and walk back their quantitative easing, and as soon as they had a structured when are they going to do it moment, and a formula that created some certainty for the markets, then the inverse relationship where strong numbers, lower stock prices kind of ended. And I think that would be the time where you stop getting this conundrum or inverse good numbers, weak market to end when they start to raise rates and they have kind of a scheduled progression in which they're going to do it. So there's not like when uncertainty involved, if that makes sense. Secondly, you still get inverted relationships or reaction from what they should do to what they actually do. This just gives us a reason why the inverse reaction to this number happened. But a sign of weakness is when they can't rally on strong numbers. It's a look out below moment. George, you ever see those helmets or those hats, those hard hats they put on people's head that have the bear and a straw from the bear to the guy's mouth? And he's always walking around with bear on his head. That's what you should be, only trading monitors. A helmet with trading monitors. So when you're walking around, you always know where the market is and put something on. So Brad asks another question. I would enter a short position. It pulls back and tests where the stuck bulls entered and will sell and get out break even. Would that be a good entry to get in? Absolutely, Brad. To see where the longs got stuck on the way down to that particular move. Hey, Jill. I wanted to read your email. It was a good add-on to the emotional capital part of analyzing your trading. Mind if I read that email? Jill also asked, what about speed of reaction? Sometimes I see immediate reaction. Sometimes it seems like there's no reaction, but it's just a delay. Then there's a big move. Is there anything to look for how rapid the reaction is? Usually the reaction, Jill, is going to happen before you actually hear the release because of these high-frequency machines plugged in to really grab that first initial jerk. You're going to let it play out a little bit. Sometimes you get faked out. You don't get the reaction, and you think, well, it should have been a bullish reaction. It wasn't. I'll get short. Then you get the delayed reaction. That's tough to time because it's going to fake you into thinking, well, it should have went up. It didn't, so I'll get short. Now it's going up. So you still got to have an exit strategy where to get out. I'd like it to go and come all the way back and then leak below where it started to create my bias of being bearish. ISM is a good number tomorrow, second biggest number of the month. For a big miss, usually is kept an uptrend if it's a bullish miss, downtrend if it's a bearish miss for the entire session. But because of this central bank conundrum inverse relationship, that could change tomorrow's reaction if it's a big miss. See, sometimes the market, let me take the screen back, George.
All right. You need me to do anything?
No. Sometimes the reaction is, I forgot what I was going to say. Is met with a lot of selling, okay? And that creates it to walk back down below where it started and create the subsequent weakness because the smart money, bigger overall funds used the buying after this number to get out of longs. And that traps so many shorter-term, medium-term traders long that they help create the selling. Remember, markets don't go down in price unless there are people that still need to sell and they haven't yet. If everybody who sold, then we'll probably go up. But if people who try to sell can't sell is when we go down. So you got to have stuck longs in order to continue to have lower prices and continued weakness. But you keep getting the guys buying this thing and getting long and wrong and long and wrong because they see a strong number. And at some point, it takes them too long to just say, hey, guy, if it was going to rally, it would have. Don't try to, in other words, don't try to catch a number on the original initial print. Because if it should go initially, it will go. And if it doesn't, could be a lot of different reasons and context going into the number. Could be a lot of other context that you have to understand in order to answer that question completely. Like what's going on going into that release. maybe you already got the market's a little too long anyways. Short-term guys are too long going into the number. It's a bullish reaction and wham, they delayed reaction and don't go down, or it could be a lot of different reasons. Don't try to understand it in a vacuum. All right, let me pull up Trade the News, and let me pull up Jill's comments first. Hold on. Here we go. I'm going to read the whole thing, Jill, if you don't mind. All right. Since I am new to the room, now listen, this is really, really good. It's a good thought. It's an excellent email, and it's a great potential exercise. Since I am new to the room and the edge, you may have already talked about this, so if you have, toss it out. But if you haven't, I think it may be interesting to some of the traders. When we evaluate our trades, we tend to look at the bad trades and try to figure out what we did wrong. We don't evaluate the good or successful trades because we make the assumption that since the trade was successful, we did the right thing / made the right decision. There's a good chance that many of those successful trades were made for the wrong reasons, but by luck it went our way. Or it may be that there was good reason to put on that trade, but those weren't our reasons behind why we made the trade. So the next time we make the same trade for the same reasons and it doesn't go our way, we are confused. It slows down the learning. So it's valuable in our learning process to evaluate our winning trades at least as critically as we do our losing trades. My reply to that was, this is an excellent point, and I'm glad you bring it up. I try to address it in the sizing plan / emotional capital lessons in the course, where you score your winning trades based on effort. Your point takes it a step further, and you would want to score it based on, quote, did it fit inside your setup? Did it fit inside your rationale for taking the trade? Either way, analyze it, score it, dissect it as part of reviewing your trades. Why did you, listen, if you guys are not making 20, 30, 50 trades a day, it's not hard to review your trades. I remember printing off our trades. We couldn't print out our trades, and then technology caught it. We were able to print out all our trades. And it was, sometimes we make so many trades, you just have a stack of papers. And the last thing we would do is print out their trades and take our trades home and go through them. And I said, you say you're going through your trades, and I would talk to my friend. I said, well, what are you going through? What are you doing? We're going through it and just looking at them. It ain't no review. It's just you're looking at a bunch of trades. You're long, I'm short, I'm long, I'm short. So I said, here's what I got to do. And this is when I was making a lot more trades. The markets were either busier for a longer period of time. And it was, I would circle the trade, the direction of the trade, L or S, long or short. And man, I was trading like crap if I had a lot of L, S, S, L, L, S, L, S, L, S, L, S. And I'm like, damn it, I'm a bull and a bear in the same 2 minutes. The hell's the matter with me? Right? I'm like the Exorcist when her head's spinning around. Right? So it's okay to go from bullish to bearish, long and short. But if you're doing it, you're getting spun around, then you got to recognize that. And so that's how I would review it. You're going through all these sheets of paper. If you're only making 3, 4, 5 trades a day, it's easier to go through them and say, okay, I have 3 winners, 2 losers. Average winner, average loser, that's easy enough. Number winner, number loser, that's easy enough. Is the winners fit your profile to why you wanted to get in the trade. First of all, were they hard or easy based on the emotional capital score 1, 2, 3. 1, a winner with a 1 attached to it's what we want. 2 is okay. 3 is what we want to avoid. But hey, we'll take a winner. We just got to recognize it wasn't the kind of winners we want to stack up. But to Jill's point, criticize your winners, and it'll help you not get so confused when that same trade didn't work again or the next time. Also realize that there's a probability they're not always going to work. But at least you could quantify from your email, and correct me if I'm wrong, Joe, but at least you could quantify better if that particular setup is a good high probability trade. And then you'll get better and better in executing that trade. That's what the small groups will do. You guys have come up with ways to since you're learning the stuff the right way, you've come up with better exercise, the right exercises. And it's not like you guys are learning to lift weights the wrong way and you guys are just throwing, 45-pound weights around and thinking you're exercising. You actually come up with better ways to exercise because you all got now the same strong foundational principles. An idea that I have is a market correlation party where I'd like guys, I don't want to do this now, I want to do it at some point in the near future, actually mandate, you guys don't have to listen to me because you don't work for me, but mandate everybody finds markets or look for markets that are working good correlations. Leaders. When you share it with this group, you're not giving away an edge. This always will be a small, a small, close-knit group, relatively speaking. And trust me when I tell you, relationships are the whole game. And early on in a prop firm, we used to worry about he hired more people, less of an edge. And the more people he hired, the more money everybody made. Just didn't matter. Didn't matter. So you want to share correlations that are working for you in hopes that someone share back with you. It's just win-win in this group. Would you do it in a public forum? No. Why would you? What kind of effort, what kind of people are going to reach back at you and say, hey, and watch this market. Now we've got several dozen eyes watching correlations. The best edge in the world is leader follower, period. Could be the VIX, could be an ETF, could be on days where ETF and the multinationals lead the index. Just ingenious ways to, when the Iraq first Gulf War happened and they had that press conference and if they came out together, that was going to be bearish for bonds. If they came out separately, that was going to be bullish for bonds because war was imminent. It's pretty simple, but ingenious, that story that a guy put on a huge bond trade based on the Secretary of State Baker coming out separately from his meeting with the foreign minister of Iraq to try to avoid war. They came out together, they reached an accord. They come out separately, they haven't. All right, let's go through Trade the News and wrap things up. Trade the News. This is what it looks like. There it goes. They have a cool, I don't have the global equity news up because I don't trade individual stocks, and anything that's pertinent that comes through a stock, that'll get released on this channel. So just pay attention to the upper left first. These are all, if I click this, anytime he comes up with a story that's important, gets squawked out. If I do that, it mutes it. This is the open outcry, the quoting of the pit. I do it for noise filler. It's an add-on. You don't necessarily need it. I just like it because it's an add-on. This is just a live test to make sure your speakers are working. So unless you trade individual stocks, you don't need this. But if like Goldman Sachs had a big news story that's going to affect indexes, it'll come across this channel. So there's different channels, different volume settings. So when this guy's talking, it gets drowned out when this guy comes on because my volume settings are different. Makes sense? So what's cool is anything that's good or important, it'll come up on this wire. And you could click and read the story that they updated. Like Andrew mentioned, this was when we came on, the preview to the USDA quarter one grain stocks and 2015 prospective plantings. Then the release is up here. It's highlighted in yellow. It's a bigger story. Consumer confidence, a big story, came out down here. Here's the release. They squawk it out and they print it. They got a morning report. They got top stories. So if I click on top stories tab, it's just the highlighted ones. Make it easier to go through to say, what the hell moved the market at this time? I can see if there was any news that moved us. I'll read this, like in the morning. Just some of this stuff in here. This is from today. So midday you could read some of that stuff, or you can go through and before the market opens, equity markets opened, mixed following the gains, blah, 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 blah. So it's a nice piece of resource and news. They used to give me a link to have you guys do trials or anybody I knew, but I lost the link. There's nothing in it for me, for you guys to do this. So do it if you want, don't if you don't. I like it. So I'm not promoting them because of any other reason than it is a pretty good service for the money, and I need something like it. The costs are all over the board depending on where you're at. It's funny because if you're in the U.S., it's a little more than if you're going to subscribe to this in another country. The bottom graph is kind of neat. Is there was a story that came out, and then you could see what this S&P did. So you could say, wow, the market broke at this time. So you could go over here and say it broke because German unemployment was actually stronger than expected. It was that inverted trade Ken was talking about. So you can see what news story came out and the kind of reaction it had. So that's pretty neat. It's roughly $150 a month for it. It all depends really on where you're at. From a trading standpoint, how much is in your account, how much you've been able to make or not make, what kind of costs get to be too heavy or too much. But you got to look at like subscription costs and stuff is like what it costs to have a license to be a doctor or a pilot in a particular state. There's always costs. Some are expensive, some aren't. There's educational costs for certification for your Series 7 if that's a career path you go on, or I don't know, it's just always and that's what you gotta say, how much is too much. And if you're making money trading, then you gotta have another resource. Just it's like even the prop firm is we had one guy that would trade and also watch Bloomberg, Reuters and stuff and squawk it out. And then as we got bigger and made more money, the firm hired a guy, and his only job was to watch it, and it alleviated work off the guy who was trading and doing it. And then as we got bigger, he hired another guy, and then we got up to three guys that weren't even trading, just watching all the news and stuff, squawking it out, putting together morning wires and stuff. That's what I'm trying to do, is create more briefings and structured like places to find that information to start your day, to end your day, and things like that. And I think that's where a bell-to-bell room would come into place, as long as I'm not a slave to it. So I got some ideas for it. Don't ask me when it's going to happen, because I don't know. But those who are also in the room, not all these edge guys are in the room, but those who are also in the room, that is something that could happen. It's just the when and the how. Take it from there. But Jill, great email. Thanks for sharing. And I think that's where the small groups will come out and help. A couple things on the calendar. I got Kepler to do an edge-only webinar on his Delta Accord. It's not going to be how to be an expert market profiler. It's how to execute some biases that a profile might give you. He did a little bit of a Delta Accord webinar like a few months ago for edge-only guys, and I'm going to do another one. Possibly as early as next week for next week's class. And then Woj, who had to cancel last week because of a death in his family, will come back on either next week or the week after. So that's what we got the next couple weeks. Take your time, go through the group coaching sessions. If you just started this Edge program, whether you're listening on recording or you're live, make sure you go through it like I instruct on the email. Make sure you read the ebook. I don't like when people say I didn't know there was an ebook there. All right, Jill. I didn't know how much people would like this session, Jill. Really enjoyed it. And this is important, how to take these numbers and understand them as traders and not economists. I mean, I took it for granted because I had a go-to guy to talk to, and just then all of a sudden I became a guy that could explain it. We go to him and say, his name was Scott, unbelievably smart guy. He's one of those guys that no matter what he was going to do, I don't know if he's still trading now. He moved to Tennessee. I don't care whatever he decided to do. If he's still trading, he's making money. If he's selling insurance, he's making money. Just a real smart, sharp guy. And that's where I did some of my learning from. What's going to be cool is, for those that in several months, let's say, come to the Edge, invest in this course, and they get all this content, is like, might even be overwhelming. Who knows? If they take their time with it, there'll be 11 videos that are short, and then could be 25 90-minute group coaching sessions, and all of them will have titles, and they're pretty. I try to sequentially put them out, but if you notice, I don't number these, class number 5, because class number 8 might be good to watch after 3. So I wanted to be flexible to lay them out as, people should watch them. Right now, they should watch them from when we started till now, but just imagine the content that people get ongoing, but then all the stuff that's recorded. Drew, I should charge you extra for that comment. All right, I'm going to stop recording. It's the end of this session. If you guys got any questions, I'll hold them over after this recording.